Hi, my name is Paul Day. I'm the Director of Business Development for Clever Lending, and welcome to our first Lender Insight one-to-one video. Now, given the current activity in the seconds marketplace, combined with the recent figures that we've seen from the Finance and Leasing Association on second charges, we thought it wise as a specialist distributor to find some questions to one of the leading and most proactive lenders in this space and get some views on the current market and discuss, more importantly, where the opportunities lie for mortgage intermediaries. So with that said, I'd like to introduce you to Marie Grundy, who is the MD of Second Charge Lending in West One, who are part of the NRA Specialist Finance Group, who, like Clever, not only transacting second charges, but also specialist buy-to-let, development finance, and bridging. Now, Marie's also had a number of senior positions, one of which was the MD of a second charge mortgage brokerage. So she does know what she's talking about, and has also represented the Association of Finance Brokers and been on the board of mortgage intermediaries. So that said, hello and welcome to Marie.
Good morning, Paul. Thank you very much for having me today.
No worries at all. It's a pleasure to have you here. I bet between us, actually, we've got about 50 years industry experience, but I better move on because we're going to give ages away that, and I don't want to ask a question about ages. So in that opening, I referenced the data, the FLA data. So both of us have seen those figures. They're looking healthy, so we're back on track for a full recovery. What do you think, from your perspective, are the main drivers behind this activity that we're seeing in the second space?
Yes, so I mean, clearly, last year was a very difficult time for the second charge market, as it was for other sort of areas of lending. And I think what's really been fantastic to see right from the get-go of the start of this year is the recovery of the second charge market has really happened, probably a lot faster than even we anticipated it would. So I think that the appetite from the lenders that are really meaningful in this space has been there, and that's really supported the market. And that's what obviously is our broker distribution really needs to have good products and a good breadth of lenders to be able to meet a really wide variety of needs. So, I mean, certainly debt consolidation is always very prevalent within the second charge market. And that can come from two forms from our experience. So there are obviously those borrowers that may need to review their finances to put themselves in a much better position where it makes sense to do that. But also we're seeing a lot of borrowers finance home improvements. So we're seeing an element of credit card spend being used for home improvements. But we're also seeing direct applications for home improvement loans coming into our business now, and that's a really key driver of new business demand for us right now. So a lot of people during lockdown have been working from home and want to create a more working friendly environment within the home. Others have just used that opportunity to sort of spend the time that they've got at home to make their whole living environment a lot more pleasant. So we definitely have seen a spike in home improvement activity. And that's not just sort of small scale projects. We're also seeing larger loan sizes being driven through this sort of loan purpose. So, high net worth clients that have properties valued over £1 million is a really good example. And they need to access a large sum of money to finance quite a significant project. So we offer loans up to £500,000, for example, and we do see right now a bigger demand for larger loans for that particular loan purpose. So that's also really interesting, and I think that trend will continue. The other thing that we're seeing in terms of driving demand is property purchase. So with the sort of stamp duty concessions, and we're one of the few lenders actually that offer second charges for buy-to-let mortgages as well. So if you've got landlords that are either professional or amateur landlords, there is definitely an increase in demand for property purchase from that sector as well. So they're kind of the three main ones that we're seeing coming through the business right now. So yeah, it's been a really, really good time, and also, compliment to our broker partners as well, who've shown such resilience throughout a really difficult time and have really bounced back really strongly. So it's been a really positive year so far.
Yeah, now you started there about 2020. Now, 2020 is behind us now, and I think there's still some potential repercussions to come from that. And we can all use the superlatives that have been used, unprecedented, etc. But clearly, lender appetite is back. As you just said, it's been a positive year with second charges, debt consolidation, home improvements, larger loans associated with larger projects, and again, property purchase. When you look at the FLA data, it actually illustrates about 30% down on a rolling 12-month period. But that isn't the proper story. That's not the most relevant point. Demand from consumers is strong there for the many reasons that you've just stated there. The purchase market has heated up, stimulated by that stamp duty holiday. But where do you feel the opportunities are for intermediary with second charge of their client? Do you think after the stamp duty, there's going to be an appetite for moving from move to improve?
Yeah, I mean, I think whenever there is, when the property market is hot, then clearly home improvements are probably less visible, but certainly where there is a cooling of the property market, you definitely see a spike in demand for home improvements. So I think that is definitely something that could continue. And also I think the positive output of the stamp duty holidays that hasn't driven demand, particularly within the second charge market. So we know that, you know, solicitors and mortgage brokers have been extremely busy over the last few months just trying to meet that initial deadline. And we know that, you know, there's the sort of tapering of the stamp duty still to come. But what's been really positive from my perspective is that stamp duty concession isn't responsible for the spike in demand for second charges. So for me, this growth is sustainable. And actually, I think it will only go on and improve because hopefully mortgage brokers now will be looking at their business model and thinking, okay, what's next after stamp duty? And second charges is clearly a way of continuing to offer really valuable product options for clients and give their clients and their businesses other alternatives that they wouldn't necessarily have. So yeah, I do think that this improve rather than move concept will definitely continue to fuel strong demand within the second charge market, without a doubt.
Yeah, absolutely got to agree that. So looking beyond the stamp duty holiday, that potential shift improved don't move, which is one area intermediaries can look at. Now, some advisors, as you said, were looking at business model, what is going on down the track. One of the things I wanted to talk about is product transfers. There's been a lot of talk about product transfers previously and what's happening now. A lot of this business is being transacted self-serve execution only. Data illustrates that product maturities this year are higher than last year, almost by 50%. Are going to be even higher next year. Surely this must present an opportunity for brokers going forward for servicing additional borrowing needs.
Yeah, absolutely. I mean, I've talked about this quite recently in a number of articles because I really do think that second charges can really complement the product transfer market. I mean, to put that into context, I think in Q4 last year, product transfer activity was 4 times higher than traditional remortgage transactions, and this is only going to continue this trend. So there is a fundamental shift away from remortgage activity in favour of product transfers. We also know that first charge lenders are getting more sophisticated in terms of their client contact strategies and using technology to reach customers at quite an early point in that process. And what we also know is that a big proportion of these product transfer transactions are done on an execution only basis as well. So there's a big advice gap there. And like, you know, I know we've had conversations about this before, Paul, but in terms of further borrowing, if the client has any further borrowing needs, they're not met at that point of the product transfer, particularly if it's on an execution only basis. So it's a real opportunity for advisors to use the product transfer growth and consider how second charges might feed into that. So, you know, to put it into, you know, into real terms, client retention for brokers will have to probably change in terms of their strategic approach to client retention. The second charges can feed really well into that. It's an opportunity to revisit that client, establish what other borrowing needs they may have during the life of that product transfer, and use second charges for that purpose. So I genuinely think it is really important for more intermediaries to consider having second charges within their advice scope.
Yeah, I just took a note about what you said about lenders' contact strategies and brokers' retention strategies with their clients. Clearly, there may well be an advice gap, particularly for someone who does have additional borrowing needs. However, some of these people that do have additional borrowing needs will have had changing circumstances. Now, you look at some of the most search terms, Knowledge Bank recently, time in current employment, new job, maximum loan to value, defaults in the last 3 years, capital raising for debt consolidation, all leads to many of them and a change in circumstances. Now, the one thing is a little bit concerning, but on the other hand, it presents an opportunity and points out the point that you previously highlighted.
Yeah, I mean, I think from a specialist lending perspective, obviously, second charge lenders generally operate a more bespoke approach to underwriting. So they're taking into account and they have the time to delve into a customer's circumstances more deeply, rather than just use credit scoring as a tool to accept or decline applications. So for borrowers that are self-employed or have more complex income structures, or may have had a one-off life event that's temporarily affected their credit score, but we can now see obviously that situation's been resolved and they're moving forward, and that our loan is going to put them into a much better position. Those are the type of borrowers that would really benefit from a more individual approach to underwriting, and that's something that second charges and other specialist lenders can support that the high street can't necessarily. So, and also by retaining their existing mortgage arrangements and hanging on to that, that preferential rate that they may have from the high street, and taking out any additional borrowing on the second charge, that blended rate is often cheaper than remortgaging away to a higher rate with a specialist lender. So that is definitely something that from a suitability of advice perspective is quite important for borrowers moving forward.
Yeah, well, I did have actually a question for you. Why is it important for mortgage intermediaries to include second charges within the scope of service? But clearly, you've highlighted the many reasons why an advisor should include seconds in their offering. But what option does the intermediary have in accessing second charges?
Yeah, I mean, that's the beauty of second charges. There are different options available for mortgage advisors, because look, we all know time and resource is at a premium, and sometimes it's just better for that particular advisor. It may suit their business model, it may suit their operational capacity to just hand off the customer to a master broker such as Clever Lending, who have the expertise and the knowledge of the market and can go away and do all the research from the wide panel of lenders that you have access to make sure that that customer is being offered the most appropriate product for their needs. And that means also that you're handing off the compliance responsibility as well. But ultimately, there's a respect there that the client obviously is very much still sat with the broker relationship. So there isn't that threat of losing the customer by doing it that way, and that's one way that can work really well. The other alternative actually is for brokers who do want to provide the advice, that have the relevant permissions to do so, then that's another option. So they can research the market, they can probably work with Clever Lending to just identify the potential lenders and then provide the advice themselves, which is also really a really positive way of approaching this. But then the actual processing of the loan can be outsourced to a third-party master broker, who can then go away and process the loan with all the expertise that they have to make sure it's packaged in the right way to have a smooth customer journey. So that's also an option for brokers. I mean, there are some lenders that offer direct access to intermediaries, but we're not one of those lenders. We operate exclusively with specialist second charge broker firms, so that just varies between different lenders, but certainly you can access expertise from master brokers in a number of different ways. It's not not a one size fits all approach.
Yeah, it's just so easy to transact and offer second charges as part of the scope of business. So I think really there we've illustrated the many situations to consider a second charge, and it does present an opportunity for advisors to service the client borrowing need. And clients don't actually just come up to an advisor and ask for a second charge. They come with a story behind which is a borrowing need, and sometimes That answer is a second charge. As I said, the opportunities, they're clearly there, and you can talk to us and or West One. I'd like to thank Marie from West One for her insight. I hope you found that useful. As far as Clever is concerned, you can just pick up the phone and talk a case through with us. Stick it in an email, send it to us, or you can put it on our platform, Clever Plus. And please remember that we don't just, like West One, we don't just transact in second charge, bridging, commercial, development finance, and specialist buy-to-let. So I thank you all. I hope you found that of interest, and I hope that you can join us next time for our next one-to-one lender insight. So I'd like to thank you very much, Marie, and thank you very much for joining us today.
Thank you, Paul.